For the past few years, we've been hearing all about the big risks to our finances. Things like an AI bubble, runaway inflation, or all the political drama. But what if the real threat, the one that's actually reshaping our economy, is something much quieter? Something that's been hiding in plain sight for decades. To understand it, we've got to start with a question that's probably been on your mind, right?
It's the question so many of us are asking. The headlines all say inflation is cooling off, the Fed's even talking about cutting rates, but mortgage rates are still sky high. Car loans are expensive. It just doesn't feel like things are getting easier. Why is that?
Well, the answer isn't hiding in some Federal Reserve press conference. No, it starts halfway across the world, in Tokyo. It's a story about one of the most, frankly, boring assets on Earth, Japanese government bonds. Because for the last 30 years, Japan has basically been the financial duct tape holding the global economy together. And now, that tape is starting to peel right off. To really get why this is happening, we have to rewind the clock. This isn't some new, sudden crisis. This is the slow-burning conclusion to a story that began 3 decades ago. Picture this, it's 1992, and Japan's massive economic bubble just burst. It was catastrophic. Real estate, stocks, everything collapsed. And what followed were the lost decades. For 30 years, their economy was basically frozen in time. No growth, no inflation, nothing. So the Bank of Japan got desperate. They did everything. They cut interest rates to zero, then they went below zero. And when even that didn't work, they pulled out the biggest financial bazooka imaginable. They started something called yield curve control. Now, this sounds technical, but what it meant was incredibly simple and powerful. The Bank of Japan promised to print unlimited money to force its interest rates to stay glued to the floor, no matter what. They were going to keep rates at zero, period. And for investors in Japan, this created a huge problem. I mean, put yourself in their shoes. Imagine you run a giant Japanese pension fund, and you have billions of dollars to invest to pay for people's retirement. But back home, your safest investment option, a government bond, pays you literally zero. So you have a choice. Either make no money or go on a global shopping spree. Well, they chose the shopping spree. And oh boy, what a spree it was. This huge flood of money leaving the country turned Japan into the world's ATM. They became the #1 foreign owner of U.S. government debt. They were a top buyer of the very bonds that back American mortgages. It got so big that Japan became the largest creditor nation on the entire planet. Now, this massive wave of cash wasn't just random. It was all being driven by this incredibly powerful, almost too good to be true financial engine, one that basically provided cheap fuel for the entire world for decades. It's called the yen carry trade, and it's way simpler than it sounds. Let's imagine an investor. We'll call him Bob. Bob goes and borrows a ton of Japanese yen, where the interest rate is basically zero. It's free money. Then he takes that yen, swaps it for US dollars, and buys a US Treasury bond that pays him, say, 4%. He just gets to pocket that 4% difference pretty much risk-free. It was a free lunch. Okay, now multiply Bob by thousands upon thousands of giant hedge funds, banks, and investors all doing the same thing. What you get is one of the biggest sources of cash the world has ever seen. At its peak, this trade was estimated to be worth over $1 trillion. This wasn't some niche strategy. It was a fire hose of money pointed directly at global markets. And here's the thing about free money. It doesn't just buy safe government bonds. Oh no, this cash flowed into everything. Tech stocks, real estate in every major city, emerging markets, you name it. For 30 years, it was like the entire global financial system was running on free, super fast Japanese Wi-Fi. But the whole thing depended on one single critical assumption. That assumption was that Japanese interest rates would stay at zero forever. And in 2024, that assumption was absolutely shattered. I mean, just look at this. It's a total 180. Everything that was true for the last 30 years, it's now flipped on its head. Rates that were near zero are now rising. That profitable yen carry trade, it's unwinding fast. And that river of capital that for decades flowed out of Japan is now starting to rush back home. And this was the trigger. After 17 years, 17, of zero or negative rates, the Bank of Japan finally did it. They raised interest rates. And just like that, borrowing in yen wasn't free anymore. The simple math that powered this entire global machine, it just broke, and markets were officially put on notice. So this is where the story comes all the way back home to the US. Because as this whole 30-year party unwinds, it reveals a really hard truth. The Federal Reserve, well, it doesn't actually control the interest rates that matter most to you and me. Look, we all hang on every word from the Fed chairman, right? But the reality is, the Fed only truly controls the very, very short-term interest rate, like the overnight rate for banks. The long-term rates, the ones that actually set your mortgage, your car loan, those are determined by the raw forces of supply and demand in the bond market. And hey, don't just take my word for it. The legendary investor Ray Dalio said it best. The bond market is the backbone of everything. Its interest rates are the bedrock. They determine the value of literally every other asset on the planet. And right now, the supply and demand for that bedrock is changing in a huge way. So let's just connect the dots. For decades, America had a massive, consistent customer for its debt. Japan. They bought our bonds no matter the price. But now, they're stepping back. They're bringing their money home. And when a huge buyer leaves the market, what happens? Well, you have to offer a better price, a higher interest rate, to attract new buyers to lend you money. It's that simple. And that one simple fact kicks off a huge domino effect. The first domino to fall? The stock market. See, when Wall Street tries to figure out what a company is worth, they use long-term interest rates to calculate the value of its future profits. So if those rates are higher, all those future profits are suddenly worth less today. Stock valuations get squeezed, even if the company is doing great. The next domino? This one hits a lot closer to home. It's your mortgage. Remember that question we started with? A 30-year mortgage rate is directly tied to the interest rate on the 10-year Treasury bond. So if the global demand for that bond is weaker because Japan isn't buying, its rate, its yield, has to stay higher to attract others. And that means your mortgage rate isn't coming back down to 3%, no matter what the Fed does. And finally, the last domino is the entire corporate world. Higher borrowing costs for companies mean fewer big deals, it means slower growth, it means less hiring. For 3 straight decades, the US economy benefited from this huge unspoken subsidy from Japan's cheap money. And now, the free lunch is officially over. So if this is such a fundamental shift, if it affects everything from stocks to your mortgage, why isn't this front-page news? Why is everyone still talking about AI and inflation while this is happening right under our noses? Well, because it's complicated. It's messy. Stories about cross-currency basis swaps and capital reallocation don't get clicks. It's so much easier to run a loud, simple story about a single rate cut from the Fed fixing everything. We're sold this idea that someone will always, always show up to buy our debt. But for the first time in a generation, that's no longer a guarantee. And that leaves us with a question that should be on everyone's mind. The most dangerous risks are never the loud ones everyone is watching. They're the silent, structural shifts that hide in plain sight. The cost of money is fundamentally changing for the entire world, and we are only just starting to feel the impact.